The first stock I ever bought was Apple. I placed a measly 2-share order in my brokerage account, and I remember being terrified of hitting that buy button. I must have checked all the values at least 1,000,000 times to make sure I was doing everything right. And then finally I hit the buy button, and guess what? The price got away from me by a few cents. So I adjusted my limit price again and again and again, until finally I was able to place my very first trade after 2 long hours of panic and anxiety and other similar emotions I had only felt during an invasive pelvic exam. Have you had one of those? Trading today takes me less than 5 minutes. Once you understand the basics, it's very easy to place a trade. Also, have you wondered how brokerages charging 0 commissions make money? There is no free lunch, right? How are these brokerages giving you free lunch, dinner, and dessert? I'm going to talk about that. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I've helped dozens of women take control of their financial future. Subscribe to my YouTube channel and follow my Facebook page so you can learn how to build your own wealth through investing. This video is the 3rd video in my series on the basics of stock market investing. Before we begin, a quick disclaimer. I will be discussing some stocks, but I'm not recommending that you buy or sell any of these names. In my previous video, I talked about secondary markets, which include your exchanges and alternative trading venues. Then I talked about order books and how orders get matched between a buyer and a seller. I also talked about different types of positions you can take in stocks, which includes long positions, short positions, and leverage positions in detail. In case you missed the video, here's the link. In this video, I will talk about the different types of orders you can place while making a trade. I will also explain what the actual trading process looks like from start to finish, so you don't have to experience the emotions I experienced when I placed my first trade. I will also talk about different market participants. So let's begin. There are a number of factors to consider when choosing a brokerage. The types of securities you want to trade, and the fees the brokerage charges for different types of securities. Some brokerages charge more for you to be able to trade options or mutual funds. So it's important to choose a brokerage with lower costs for the securities of your choosing. Another consideration is the account minimums. Some brokerages require you to have a certain account minimum asset size before you can start trading on the platforms. This is especially true for mutual funds. Another consideration is reliability. Remember the GameStop short squeeze? I had discussed it in the previous video in the series. When the short squeeze happened, Robinhood had halted trading of that stock on its platform. I'm not saying that Robinhood is unreliable, but look for a brokerage that has a good track record and is reliable. Let me now talk about orders. There are 4 kinds of orders as they relate to stocks: buy, buy to cover, sell, and sell short. Buy order refers to the purchase of a security. Buy to cover is the purchase of a security to cover a short position. I talked about short positions in my previous video and have linked it in the description attached to this video. Sell order is for full or partial liquidation or sale of a security that you hold in your account. And a sell short refers to the borrowing of a security from your brokerage to sell immediately with the intent of buying it later, hopefully at a lower cost. Let me show you what a sample trade page looks like. Under Action, you can select what kind of order you have. Buy, buy to cover, sell, or sell short, for example. Fill in the ticker. Ticker is the identifier of the security. So, for example, for Apple, the ticker is AAPL. Then fill in the quantity or number of shares and select an order type. For each of these 4 orders, there are 3 main types of instructions that you can send to your broker. The first one is a market order. When you put in a market order, you're instructing your broker to execute the order immediately at the current trading price. So for example, if Apple is trading at $100 and you put in a market order, your order will get executed at $100. A limit order is a conditional order. When you select this order, you have to also specify a limit price. This order will instruct your broker to get you a trade price that is at least as good as your limit price. For example, if you instruct your broker to buy a certain number of shares of Apple at a limit price of $100, your broker will route that order and it will get executed only if Apple is trading at less than $100. So if there is an open sell order at $98, your broker will buy shares of Apple at $98. If there is an open order at $100, your broker will buy shares of Apple at $100. However, if Apple starts trading at $101, your broker will not execute that order and your order will remain open. And your broker will wait until the price of Apple falls below $100. If instead you direct a sell order with a limit of $100, your order will get executed if and only if the stock is trading at least at $100. So for a buy order, your limit price is the ceiling price at which your order can get executed. And for a sell order, it is the floor price at which your order can get executed. For highly liquid securities, I choose either market orders or limit orders. Liquid means the security trades very frequently and has a decent trading volume. I'm going to talk about liquidity at a later point. For illiquid securities that don't trade very often throughout the day, it's preferable to use a limit price to avoid your trade getting executed at an unacceptable price. Next is a stop order. This type of order is used to limit the loss or protect the gain on a security that you own. As an example, let's say you bought Apple at a price of $100. And let's say now Apple starts trading at $200. So you've gained $100 per share on that trade. But you don't know whether Apple will rise further or fall. So you don't want to sell Apple just yet. However, if the price of Apple starts to fall, you want to protect yourself and limit your loss, or at least lock in some amount of gain that you've made. So when the price of Apple starts to fall, you can put a stop order at, say, for example, $190. So when you do that, and if Apple's price starts falling, as soon as it reaches $190, your stop order becomes a market order, which means as soon as it falls below $190, your order will get executed immediately and you will protect your gain or limit your loss. However, if the price of Apple continues rising, your order will never get executed. Finally, you can select the duration of your order to either day order or good till cancelled GTC. Depending on your brokerage firm, you may have many other options available on this screen. In the United States, regular trading hours are on weekdays, excluding market holidays, from 9:30 a.m. to 4 p.m. A day order only gets executed between those hours, 9:30 a.m. to 4 p.m. If by 4 p.m. your order is not executed, it will expire. And if you want this order to be executed, you will have to put in a fresh order on the following business day. Or if you selected the good until cancelled option, this order will carry over to the next business day automatically. The number of days your order can get carried over varies from broker to broker. There's one more special instruction that you can send to your broker. This is all or none, AON. Back in the day, brokers used to charge commissions per trade, and they were pretty steep too. I remember paying $4.95 per trade on Options House a while ago. So if I bought one share of Apple, I would pay $4.95. Or if I bought 100 shares of Apple, I would still pay $4.95. So if I had a large order that needed to be broken out into smaller chunks, I would have to pay a commission equal to 4.95 multiplied by the number of chunks this order was broken into. So in such cases, I could specify to the broker that I wanted to get the entire amount executed and if I was not able to get the entire order executed, then do not execute any amount of shares at all. A lot of brokers charge 0 commissions now, so this may no longer be relevant for smaller trades, but do check your fee arrangement with your broker and decide for yourself if you need this AON instruction. This was all about the instructions that you can send to your broker to get your trade executed. There are many more different options available for institutional investors, but I'm not going to go into those. There is one more section that I want to show you. This interface may look different for your brokerage platform, but this is what it looks like on one of my accounts. The first line here shows you the last price. This price keeps changing throughout the day. I'm logged in at midnight on a Friday after market close because I have nothing better to do. So it shows a constant price, which was the 4 p.m. closing price for Apple. The second line shows today's price change. The price of Apple has moved up 0.47% over the day since yesterday's close. The last trade was for about 7 million shares on the NASD, which is the NASDAQ. This section now shows the first line of the order book. This part shows that there is a buy order for 6 shares with a limit of $157 on the Pacific Stock Exchange and a sell order for 2 shares with a limit of $157.13 on the PSE. Then it shows the range over which the stock traded during the day. And finally, the last line shows the day's volume. About 116 million shares of Apple were traded during the day. Contrast Apple with a microcap stock, Lantheus Holdings. The bid price is $64.40 and ask price is $65.18, making the bid-ask spread equal to 78 cents. The day's volume is low at about 1 million shares. If you like what you've heard so far, please smash the like button. And if you haven't already, please click the subscribe button and then click on the bell icon so you don't miss any of my latest videos. Also, if you're watching me on Facebook, don't forget to follow my page. I have also linked my budgeting worksheet and my investment plan template in the description to help you create your own investment plan. And if you don't know how to do it, watch this video where I talk about how you can create your own investment plan. I was just telling you about how brokerages have reduced the commissions they charge their investors. Some brokerages even charge 0 commissions. How do you think they make money? There is no free lunch, right? Let's first look at what the trading process looks like. From the moment you click the submit order button to when the trade settles. In my previous video, I talked about how you can trade, but not directly through an exchange. You as an individual or even an institutional investor cannot have an account directly with an exchange. You need to go through a broker. Here's what happens when you click the submit order button on your buy order in your brokerage account. Your broker may then route your order to an exchange. On the exchange, your order will then get matched against another order that was routed by the seller through a seller's broker. If these orders are market orders, they will just get matched. If it's a limit order, matching implies that the seller's price is at least as good as the buyer's limit price. If a buyer's order is not matched against a seller's order, both buyer and seller are able to adjust their limit prices until the order gets executed. This is similar to how you would bargain at a flea market. Both the buyer and the seller would adjust their prices until they come upon a mutually agreeable price. Once an order is executed, money then has to flow from the buyer's account to the buyer's broker, from the buyer's broker to the seller's broker, and finally to the seller's account. And then shares will have to flow from the seller's account to the seller's broker to the buyer's broker and finally into the buyer's account. And while this sounds very simple, there's a lot of work that takes place at the back end, and the process takes time. Back in the day, it would take as long as 14 days for the funds to flow from the buyer's account to the seller's account and for shares to be transferred from the seller's account to the buyer's account. Since 2017, this process takes 2 business days. This is also known as T+2 settlement. T stands for trade date or transaction date, and T+2 means 2 business days after transaction date. By 2024, the plan is to make it into a T+1 settlement, so it would take only 1 day for settlement to occur. And eventually the plan is to move to a T date or a transaction date settlement. On T date, the trade is matched and executed, meaning the buyer and the seller agreed on a price and quantity and agreed that a transaction will take place and the trade gets locked. The trade details, basically information about which security, the quantity of shares and price, will then get sent from the exchange to the clearinghouse. A clearinghouse is an entity that takes the responsibility of settling the trade, making sure the buyer receives the shares and the seller receives the money. The clearinghouse confirms trade details with brokers through a trade confirmation. At this point, brokers are legally required to complete the transactions. Clearinghouses take on default risk from both parties. If either party fails to settle the trade, the clearinghouse will settle with its own capital. Meaning, if the seller fails to deliver the stock or the buyer fails to make the payment, the clearinghouse bears the risk of making sure that the trade happens. Here's what happens on trade date. Money flows from the buyer's account to the buyer's broker's bank. The buyer can no longer access this cash. Shares flow from the seller's account to the seller's broker's depository. There may be many buyers and many sellers trading millions of shares of different securities every single day. At any given date, the same firm can be a buyer's broker as well as a seller's broker on different accounts. All these transactions get netted at the end of the day. On T and T+1, that is trade date and the date following the trade date, the clearing corporation informs the brokerage whether it is a net buyer or seller of shares. On T+1, money deducted from the buyer's account will go to a clearinghouse. At the same time, shares deducted from the seller's account will go to a central depository. On T+2, money from the buyer's broker's bank will flow into the seller's broker's bank and into the seller's account. And shares from the seller's depository will move to the buyer's depository and finally into the buyer's brokerage account. You don't need to worry about how exactly this happens. All of this happens behind the scenes. What you need to worry about is when the settlement occurs, which is T+2, which means between the trade date, which is T, and the settlement date, which is T+2, money flows from the buyer's account into the seller's account, and shares will flow from the seller's account into the buyer's account. Shares won't be available in the buyer's account until they settle, that is until T+2, and funds or proceeds from the sale won't be available in the seller's account until they settle. There's one more thing that happens between T and T+2. The clearinghouse informs the issuing company of ownership changes. Companies employ a transfer agent. This transfer agent will keep a record of all beneficial owners of a company's stock. When shares are transferred from a seller to a buyer, the transfer agent records the buyer as the new beneficial owner. That way, the company knows whom the dividend payment should go to. Or if there are other corporate actions, which I haven't discussed yet, but will discuss in the series, the new beneficial owner gets notified. Here's why it's so important to understand the actual trading process. Let's say you own some shares of a company and you plan to sell those shares and use the proceeds to fund, say, a down payment towards your home purchase or any other liquidity requirement that you may have. If your down payment is due today, you cannot expect to have the proceeds available if you sell your shares today, because remember, it is a T+2 settlement. So you won't receive funds from the sale of shares until 2 days after the trade date. So in order to have the funds available today, you need to trade at least 2 days in advance. Now let's see if you are a buyer. What happens if you're a buyer? Apple paid out a dividend in May of this year. The ex-dividend date was May 6th. If you were to purchase shares of Apple, can you purchase them on the ex-dividend date and expect to receive a dividend from Apple? The answer is no. There is something called as record date. That's the date the company checks its record of all beneficial owners of the company or shareholders to see who's entitled to a dividend. This record date is typically 1 day after the ex-dividend date. So in order to be entitled to the dividend, you need to make your purchase 1 day before the stock goes ex-dividend. If you make the purchase on or after the ex-dividend date, the seller is entitled to the dividend and not the buyer. Now let's look at all the entities involved in making your trade happen. First is your broker, which is typically a firm with many employees, systems, and fixed costs. Next comes the exchange that matches your orders to other orders. Again, this is usually a massive electronic system that needs to be maintained and protected. So again, there are costs involved with running an exchange and facilitating trades. The third entity is the clearinghouse, which ensures that the trade goes through smoothly, and it takes on default risk of all parties involved. Fourth is the custodian or the depository, holding the money and securities, helping prevent fraud and loss of securities. Fifth is the transfer agent that records the ownership changes of shares. All these entities have their own fixed and variable costs, maintaining electronic systems, paying employees, legal costs, marketing costs, and so on. Have you ever questioned how and why these brokers are giving you commission-free trades? Back in the day, I used to pay about $4.95 every single trade in commissions. Now, practically all brokers have reduced their commissions, and some brokers are offering 0 commissions. So these brokerages have got to be making money somehow, unless you think that they're running a charity, which they're not. These brokerages are not really free. So let's look at what these hidden costs are. The first one is the bid-ask spread. If you're buying a stock, you are not actually paying the seller's asking price. What you are paying is the ask price, which is what the broker is asking you to pay for that stock. This ask price is higher than the bid price, which is what the broker is willing to buy that stock from you for. Let's say the bid price is $99.99 and the ask price is a penny higher than the market price, which is $100.01. If you are a buyer, you would pay that $100.01 to buy a share of Apple, and in theory, if you sell that stock immediately in the market, you would only receive $99.99, making a net loss of 2 cents a share. This difference of 2 cents between the bid and ask price is what the broker would pocket. If the stock is not very liquid, which means it does not trade very frequently, the bid-ask spread can be very high, in which case the broker makes a lot more money from every share that is traded. The second way brokers can make money is through a margin account. A margin account is when you borrow money from the broker to invest in the market. You then pay the broker interest, which becomes an income to the broker. I talked about margin account in this video, so in case you missed it, do check it out. I'm going to link it in the description. A third way brokers make money is through securities lending. I also talked about securities lending in this video, so do check that out as well. A broker may lend out securities in your account to other investors for short sales, and they pick up securities lending income, which is like an interest in the process. The broker can also make money in foreign exchange fees if you trade in foreign stocks through the brokerage. And finally, this is a big one. Brokers can receive payment for order flow. Robinhood landed in hot water for this. 80% of Robinhood's revenue came from payment for order flow at some point. When I explained the trading process in detail, remember how I told you brokers can direct your orders through exchanges? They can also direct these orders to market makers. A market maker is a broker-dealer firm that holds large inventories of stock. They are firms that will buy or sell stock, as opposed to an exchange which does not own any of its own stock and only facilitates trades. Think of a market maker as a specialized trader that can buy stock at wholesale prices and then sell them at retail prices, making a huge profit in the process because they do it multiple times during the day. Zero commission brokers such as Robinhood can direct your orders to these market makers like Citadel Securities. And in return, these market makers can share a part of their profit with these zero commission brokers. This payment is called payment for order flow. The problem here is that there is a potential for conflict of interest. Remember the GameStop short squeeze of 2021? I talked about it in my previous video. When the short squeeze happened, Robinhood halted the trading of that security on its platform. Robinhood directs a lot of its trades to Citadel Securities. Citadel Securities' sister company, Citadel LLC, is a large hedge fund manager that had huge short positions in GameStop. So when Robinhood halted the trading of GameStop, that would have benefited Citadel LLC, the hedge fund, to the detriment of Robinhood's brokerage clients, which definitely appears to be a conflict of interest. These are some of the ways zero commission brokers can make money for themselves. Zero commission brokers are not necessarily bad, especially if you use limit orders for trading. Zero commission brokers have been making trades cheaper and more accessible to ordinary retail investors. But it's good to be aware of how you're getting charged by your broker for the use and accessibility of their platform for trading, even though you may not be paying the broker directly in fees. Invest wisely and invest for the long term. Don't fall into the trap of day trading. Remember, day traders will make lower returns in the long term than a long-term investor. The last thing that I want to talk about is regulation. In the United States, the stock market is regulated by the Securities and Exchange Commission, or the SEC. The SEC is an independent agency of the United States government. There are other regulators as well, but I'm just going to talk about SEC because we are only talking about the stock market in this series. The main purpose of the SEC is to protect investors, ensure fairness and efficiency, and enable capital formation. Companies that are listed publicly need to abide by the rules laid out by the SEC. So if you have seen the annual reports put out by companies, you have the SEC to thank for. SEC requires that each company put out audited financial statements that the public can access. The annual reports are called 10Ks and the quarterly reports are called 10Qs. I'm going to talk about that when I talk about valuation of a company. The SEC also regulates other market participants such as exchanges, brokers, and dealers. Because of regulation, you can rest assured that you as an individual investor are treated fairly and are not at a disadvantage compared to a wealthy individual investor or an institutional investor, although financial frauds have happened in the past. In my next video in this series, I will talk about how you can read and interpret financial data for an individual stock. Make sure to subscribe to my channel and hit the bell icon so you don't miss it. That's it from me this week. As always, don't forget to be happy, to be kind, and to be your best self. Bye. And here are some more videos I think you will enjoy. I would really appreciate your hitting the like button and sharing this video with your friends and family. It will help me reach more people.